Hey everybody, welcome back to the Presidio Perspective. Dustin, Luke, and Sierra in the studio for our final show, the final showdown of season 2. As we break for summer, we have a great one for you. We're going to talk about inflation, tax policy changes, interest rates, and how they can affect the different parts of your portfolio. I'm ready to go. Luke, you ready?
That's it. Let's do it.
All right, Sierra, hit it. All right, Luke.
Whoa, Mr. Cool.
It's summertime.
Wow,
man. I'm ready to
bring
go.
it, man.
That's right.
What are you getting ready for today?
I got my kids out of school yesterday, so I know that
man.
they're ready.
Chilling?
Yeah, they're ready to chill.
Right.
Hit some beaches.
Yeah, I like it. I do the beaches and pool time.
Yeah.
That's my number one thing.
Yeah,
Beaches and pool
absolutely.
time. Did you do anything fun this week?
Oh, gosh, I don't know. Yes, we've done a lot.
Yeah?
It's been a busy week.
It's been a busy week.
Yeah.
It was a good week, right? Big day Monday.
Yeah. Oh, big day.
So just so everybody should know,
I got to put my glasses back on
that's
for
right.
this
Put
one.
the glasses. My homie Dustin Tenbrook here was nominated for Investment News 40 Under 40, and I just want to bring it up. It's a really big accolade, and it's a really big deal. And people who don't know about that should really look into it, and know that that's a really big accomplishment. And
Awesome. I appreciate
congratulations.
that. Yes. They should
little
look
spotlight
into it.
here for you, who spotlights everybody.
Yeah,
I just
and
want to spotlight.
Thank you. Yeah, they're not going to be able to hide from it. I know Sierra's going to be posting them probably every 48 hours, letting them know about it. So,
Well, it's from my heart this time.
Yeah.
And I got one more thing from the heart this time, and it's about the Presidio's perspective and kind of how it's found these guardrails and really what it means to me, and thinking about like how you and I work together in this studio, and if people haven't noticed it, I'm just going to point it out that Dustin and I have very different mindsets. Dustin has this amazing planning mindset, and what he does for people with planning is truly tremendous. I have a background in institutional finance and focus on investing, and the two of us bring two really different mindsets that really is the Presidio perspective.
Yeah.
It's not just two people rapping about things. I think about how to invest to meet planning, and Dustin thinks about how to plan to meet the investment, and the two go round and round and round.
100%. Yeah, that's the description of wealth management.
Right.
And people wonder what that is. And it's financial planning, investment management, and where they meet each other.
Right.
And so bringing these two experts together is, it's been fun.
And it's fun.
Yeah.
And if I may say, what differentiates Presidio, which is the firm that we're at, Presidio Perspective, is that the two individuals that you're talking to now are directly connected to the clients.
Yeah.
Instead of being distributed in New York or Boston or from all these different areas, we are directly associated and communicate with our clients. All that value is just, it's not through some intermediate, it's right there with the clients, and that's why I'm here. I'm happy to be here.
Well, this was a good show. I think that we can end it there. Yeah, I think you nailed on everything you wanted to cover, so I love it, man.
Yeah,
That's
well, those are
awesome.
important. It's
Yeah.
the last episode, and I can speak from the heart, and just thought a little vulnerability would be good right now.
Yeah, that's awesome, man.
You
Yeah,
got it.
It's great. So yeah, we'll break for the summer as we're talking about as the Presidio perspective, but we do have lots of educational events coming up that Luke and I are going to host. So make sure that you have subscribed to our YouTube channel, follow us on Facebook. We'll let you know as those events pop up, but we're not going to go away completely. But a little break to the schedule this summer. So I always say it's a good show. I don't think people would tune in if I started off the show saying we have a bad show for you, but
We should try that.
yeah,
See what
right?
happens.
See what happens. But honestly, this is, a lot of times throughout the season and last season, of course, during the pandemic, we've been talking about current events and what's happening in the news and trying to give our perspective on what people should or maybe should not be paying attention to. So, of course, we're going to have some of that, but really talking today about some actionable items. We're going to talk about themes that we have been discussing all show that we think are going to have major impacts on pieces of your portfolio and are going to directly impact the decisions of how you invest. And so some of the things that we've been talking about this season ad nauseum is inflation, something that we'll continue to discuss, tax policy changes. There's been some news about that we've discussed and shared in the show. And we've also been talking about interest rates. Luke and I are going to talk about those three phenomena, those forces out there, and directly how they will impact the different pieces of your portfolio, or in other words, the things that you can invest in. So from a broad asset class standpoint, we're talking about stocks, bonds, commodities, real estate, and yes, cryptocurrency. So how will changes in inflation, taxes, and interest rates impact those different parts of your portfolio, and how they might impact? Obviously, we have no crystal ball, but Luke and I will share our perspective of things that we're watching for. So let's start out with inflation. And actually, we got some data this morning on inflation, just in time for the show, which was nice. So here we are, year over year, over 5%, right, with inflation.
It's a big number.
Big number. And you know, we've talked about even bigger numbers coming off of year over year, you know, in March and April, when it was really looking at kind of the height of the pandemic, of course, where prices were very, very low. So we know there's a big bounce back from those lows. But, you know, here we are looking back, 5% core inflation when you strip out energy and food at 3.8. Remember, we've been talking about this 2% average, right? Or the Fed at least has been average. So these came in at higher than expected. Okay, and so that's what we're seeing today. I mean, this core CPI increase of 5.2, that's the highest number we've had in 30 years.
It's a big number. Over the last 6 months, the average for core CPI is an annualized rate of 4%.
Right? Yeah.
Big number.
And so with CPI, so the 3-month average is that rate of change is higher than since 1991, right? 30 years. And then this CPI reading itself is the largest we've seen since the summer of 2008, which would be an interesting time in our investing history, going back to the summer of 2008. People never like to hear that something today is just like the summer of 2008. Knowing the fall of 2008, we had Lehman Brothers go bankrupt, and of course the credit crisis ensued. So, not theorizing that was all due to inflation numbers, of course, but so we know we have some big numbers. We've been talking about inflation. What about how this impacts the different pieces of our portfolio? So let's just kind of go down the list, right? Because if we're going to invest, one of the goals of our investments is going to be to preserve its purchasing power as you know, so money in the future is worth less. So we know we have to earn more on our money just to keep pace with what we have today, right? So if inflation's 5% year over year, if I made 5% over the last year, I just broke even. And that's not taking taxes into account. So really, like, you had to earn 7 or 8% over the last year just to be worth what you were worth a year ago. Right? And that's how inflation works. That's how taxes work. And so we know from an investing theme, especially our clients in retirement, living off of their money, needing it to last for long periods of time, we're going to need to be very keen on what this inflation number is and where do we invest people's portfolio. So let's just kind of go down the list, right? So when we're looking at inflation, if we have inflationary times on the horizon, okay, we're going to have inflation in the future. How will that impact these different pieces? So let's start with the stock market.
Well, you just started with purchasing power. Yeah. So immediately, I think the race to maintain purchasing power becomes a significant priority, especially while rates are low.
So companies that have purchasing power.
Well, your own portfolio. Yeah. So if you have
pricing power,
yes. So you would be moving to you could go and acquire businesses that have pricing power. They will receive a premium in that type of environment.
Because inflation is rising prices. And so what are rising prices? Well, those are goods and services that companies are providing. So if you own those companies that are raising their prices, one would assume you would do quite well in periods of inflation.
Yes. In those periods, you know, and that gets into like consumer staples, that gets into other groups that are able to raise prices. Think about all the brands out there that if they raise their brand that you like buying, maybe your cup of coffee you like from $2.35 to $2.55. It's a pretty big rate of change. Everything is rate of change. So, but really when I think about where we are currently inflation, because inflation moving from really, really low to really high is different than, say, moving high to higher.
Yeah.
And I would say that when you're moving really low to high, the first thing you're going to want to do is maintain purchasing power. And so stocks become an interesting area where where investors seek demand.
Yeah.
Right. They go to find that versus bonds. Right.
Yeah, and so I'll bring real estate as another category in there too that we kind of throw in stock. So at least historically, during rising times of inflation, low to high or even mid to high, those that have these sectors that have fared better are stocks and real estate, at least residential real estate.
Right.
And of course, just because it's the cost of goods and services. So what does the rent cost? What does housing cost? What are the things that I buy cost? And so those are supplied with the real estate and the companies that produce those goods and services and sell them. So during rising times of inflation, and it's interesting, you and I were talking about this earlier this week, how nobody in our profession has really experienced inflation. That is still here, right? They have since retired.
That's right.
The last time you've really had inflation was in the 70s and early 80s. So, if you had experienced this was 40 years ago. Mm-hmm. So, if you're 80 years old and you're still wearing your financial planning boots and investment management boots, then maybe you have some experience. But if those people were any good, they have long since retired.
Yes.
So all of us are theorizing. Now, that's not to say that a lot of our clients haven't experienced this. And if you ask those that were investing during the early 80s, they did quite well, right? They did quite well during periods of inflation. So it's something to be concerned about. We need a plan. We need to know where we're investing and how do we capture those themes. But they go, gosh, yeah, I remember paying 12, 13% on my mortgage. But their house also doubled in value over that 2-3 year period of time.
Mm-hmm. It did.
And we're seeing something like that happen in residential real estate now, except with a 2.8% mortgage.
Right.
There's a lot of margin there.
It's a lot. I think the knee-jerk reaction that people tend to move for is, well, I'm just gonna get out. I'm not gonna be in the market. Not gonna be in the bond market. I'm just gonna go out. That's where we see lots of these cash and prospect reports that we see, and that really contradicts the idea of maintaining your purchasing power.
That's
right?
the last place you want to be if you're expecting inflation.
Absolutely.
Essentially, if you're in cash over the last year, what this report is saying is you just lost 5%.
Right.
And if you think that this is going to continue, you're going to be in an investment that seeks to guarantee lose money. That's how inflation will work. Right, so guarantees so much as the fact that we will have inflation in the future. So if that is the case, sitting in cash, earning 0, and losing 5% of your purchasing power is essentially a 5% loss in that section of the portfolio. Okay, so what about how inflation? Let's theorize a little bit how this might impact investments in bonds. So bonds, right? These are loans, guaranteed. I can give my money, loan my money to some individual, a corporation, a government. They will promise to pay me all my money back at the end of a term. During the time in which they borrow my money, I am going to receive coupon payments or interest payments. Now, we know those payments are really low, but essentially I'm giving my money today for a promise of money in the future, right? So just mathematics, we know that if we have inflation, that money that I'm promised to get in the future is going to be worth less.
Right.
So higher inflation is negative for investments in our bond portfolio.
It's a huge headwind, especially when you add in duration. So if I'm lending 30 days versus 30 years, my risk there is substantially less at 30 days as I get the coupon in 30 days, and there hasn't been that much time for inflation to really impact the value of my capital.
Right.
But if you're doing a 30-year loan right now, there's a lot of risk there that inflation could really marginalize the amount that you're receiving back in principal, the money that you loaned out, and the coupon payments or interest rates that you're receiving also from that lendee.
So there are inflation-protected securities, which are bonds that have their coupon payment or interest rates adjust directly with the inflation number. So that might be one way to help insulate that effect.
Right.
Those long maturity bonds that are fixed, okay, with maybe really stable governments or corporations.
Mortgages.
Well, mortgages, you get back some of your principal typically.
You do, yeah.
So you're getting some of your money paid back to you that you get to then reinvest at theoretically higher rates. But those long-term, think about 10, 20, 30-year treasuries, where I'm just getting my money back 10 years from now, which is going to be worth significantly less. So as we talk about inflation, you kind of think as an investor, why would I even consider that? Well, it turns out that during the market crash, those are the things that provide the support and stability in the portfolio. And those are seen as the safer instruments that everybody goes into, right? So as they flee out of stocks or real estate, what happens is they buy those assets. And here we are with a 10-year treasury below 1.5. I don't want to jump to interest rates just yet.
But you're really bringing up the delicate tap dance that typically goes on in asset allocation between reaching for return in equity markets and letting go of your fixed income. And as you tap dance into the risk spectrum, you forget that I actually own this bucket over here as ballast when the unexpected
eventually, inevitably happens.
Right.
It's something that business owners, consider as they lay their 3, 5, 10-year plans, that you just know there's going to be economic downturns and things you have to survive, and investors need to think the same way. We can't pretend like they're not going to happen. We can't pretend like inflation's not going to happen either. But to completely abandon these asset classes is nothing that you or I are suggesting during this show, right? And we'll kind of end that. But okay, so inflation, the impact on commodities, that's pretty obvious.
It's been, over the last 6 months, it's just straight up.
Yeah,
right?
that's kind of a definition as well as what do these things cost? They're costing more. That's why we have inflation. It's the commodities that are going into these numbers.
As long as there is a limited supply or some sort of a demand supply ratio that continues to drive prices higher, then inflation it really goes after these areas. And when people are looking at the CPI or the PCE reports, the two things that we look to gauge inflation, they start peeling back the onion to see, okay, what
Where's it
parts
coming
of
from?
these commodities are really driving transitory inflation.
Right.
So so just for example, this month, 7.3% surge was from autos, which we talked about 2 weeks ago. It was 10% before, now it's 7.3. So commodities they're a challenge, right? And commodities, inevitably, I'll say it once again, high prices cure high prices. They tend to go up until people say, they get an allergic reaction to how high the prices are. They push back. Suddenly, then there's too much supply.
Yeah, and so this is the ebb and flow of these different parts of the portfolio as we go, right? Those that become unloved to a certain point to where it makes a whole heck of a lot of sense to go in and buy those assets now, whereas the thing that worked out very well all of a sudden is really, really expensive and gives very little hope that it could continue any kind of growth or even maintain its current price, right? And so this is why we see this ebb and flow, and why having this diversified portfolio that you can rebalance is so important. So, we'll end on the cryptocurrency. I think I covered the rest. So, there's no historical data when it comes to, but a lot of people are theorizing or hypothesizing that cryptocurrencies might be a hedge against inflation. To which I think there's some argument there if you think it's going to replace gold, right, as kind of like that type of part of the portfolio. People say, oh, you can't really use these different cryptocurrencies for purchasing goods and services. They're not that efficient. When was the last time you bought anything with gold? Right? I mean, that hasn't seemed to be why people have invested in these types of asset classes. And I throw gold and cryptocurrency in that same kind of bucket.
I think the last time I bought something with gold, I actually bought $1 with it.
That's right.
I think I actually, this was many,
That's probably
many,
the last thing you bought with cryptocurrency, too. That's right. That's right. Exchange. So who knows? Do you have any thoughts on that, or should we leave it there?
With crypto, I would say that a cryptocurrency is not a cryptocurrency. There's lots of different currencies out there. A lot of them are considered commodities and
Crypto commodities.
And the supply is different for each one of them. Right. And so tread lightly. If your bet is inflation or a store of value versus fiat, make sure you do your homework on the available supply.
Yeah. So we'll see. We don't know. All right. So I think that's inflation. Let's talk a little bit about these tax policy changes. So, we talked about it in previous episodes. Biden has a new tax proposal. There's a lot of rhetoric going on Capitol Hill, I think today or this week. And so, should there be a wealth tax, all these other kinds of things. But one of the things that we're looking at is a potential change to the long-term capital gains rate being equal to ordinary income rates for at least high income earners and larger investors. So let's just focus on that. Okay, there's other tax policy changes. Is 1031 exchange going to be eliminated for real estate, or is it going to be capped? Looks like an estate tax is likely coming back. Looks like there's other types of capital gains taxes that will come back for estates at over a certain level. And of course, the corporate income tax rate is very likely to be increased. Just we don't know to what. So we have to kind of pick something. And I think especially for our audience and where people are focused as individual investors is this long-term capital gains rate. And I think that likely, in my opinion, could have an impact on all 5 of these asset classes. So again, let's go through the list. Higher long-term capital gains rates, how might those impact the stock market?
I mean, the gut reaction tells you that it would be negative,
right?
Immediately, or that it would be short-term negative, that people would look to potentially sell in front of some impending doom.
Unless it's retroactive.
Which they've been talking about too. But I'm gonna take the other side of it just for argument's sake. I read an article yesterday where a very prominent private equity fund was already figuring out how they were going to get around carried interest, which is effectively making sure that the capital gains you do receive move into long-term capital gains to the short, so that they never pay any short-term or ordinary income.
Higher rates, ordinary income rates, yep.
And they've already, not only have they already figured it out, they already started boasting about it. So I think when you have policy changes like this, you get a lot of unintended consequences where people create new systems to get around new rules. And so I would say that for stocks specifically, given that's a big change, ordinary income to long-term capital gains, a very high tax rate to a low tax rate, I would say that short-term, that it would be a negative. Long-term, it may not be as negative as you think.
Yeah, it's interesting. I was thinking about real estate and stocks, especially those that our clients own, that have these larger long-term capital gains, for unrealized capital gains built up in positions of companies they've held for a long time, residential or commercial real estate they've held a long time, maybe done some exchanges in the past, okay, or just invested a year ago, right, at the bottom of the last pandemic and seen a big rise to pieces of their portfolio. So the number one reason, you talk to any real estate broker out there, residential or commercial, right? The number one reason that people don't sell is because of capital gains.
Yeah.
Okay. And I know, and that a lot of the individuals that we talk to, especially as they prepare for retirement, some of them haven't sold a stock in their whole investing career, right? And have no idea how they're going to do that, and have convinced themselves that they don't have to pay the tax. They've never done the study of how much of this gain is actually theirs versus how much is the government's, right?
It's a tough day when you learn that.
Yeah, I know. We have a lot of fun teaching that part. Sorry. But yeah, there are strategies to minimize that amount. But what happens is people like to pretend like it's all their money. And so what happens, one hypothesis I would have is that it will create less supply, is that there will be less selling turnover of people's positions in stocks or real estate. And already constrained, if you look at residential real estate, for instance, in this run-up, right, there's this big supply constraint and lots of demand. Well, if you start moving into more and more people not selling because of capital gains, that even limits and contracts the supply even further, which we know supply and demand is going to drive prices higher. So if you own something and the supply is now going to be limited, I guess that's good for the things that you own. So who knows? But that is one potential outcome.
I can see that.
The other thing I was thinking about, well, you were just talking about short-term and long-term, is there is also an incentive. So long-term investors are going to likely sell less, based on my hypothesis. There has been at least an incentive up until now for investors to be long-term, meaning a year and a day, because they will pay less. They'll pay less in capital gains if they hold. Now, if there's no benefit to doing that, you can be a short-term trader, and you have no incentive to hold for that year. And so now as a portfolio manager, I mean, just think of you making decisions of rebalancing and how often we have to think of long-term versus short-term and weighing that in our decisions if you don't.
That's a substantial unintended consequence, I would say, right?
And that could create, on the other side of this, a lot more volatility.
Yeah.
So
yeah, I could see that. I mean, I like that. I like that idea. I don't like paying higher taxes, but I love the concept of being able to capitalize on my investments when I'm ready to do it instead of waiting another 3 months.
And that's when you get somebody coming in and proposing a flat tax at some point, and we just make all this go away. But who knows? The other thing is, if you look about fixed income or bonds, you're like, well, that's not really something that's going to be impacted by long-term capital gains. I mean, this is interest is taxed as ordinary income, so it's not really that there's no dividends, which is an important point that we missed. Dividends can now be taxed at ordinary income if you're over a certain threshold or an institutional investor. So now you have less desirability for dividends, right? Because you don't get that tax preferential treatment, right? And so that could have major implications for how corporate governance is run, and what investors are demanding. But also, there has been a benefit to investing in equities, right? Because I pay a lower tax rate if that's a dividend-paying company versus if I bought a bond, right? So essentially, I mean, easy math would be a 2% dividend might be worth a 2.5% interest payment on a bond because of the net tax. Well, now they're going to be taxed the same. So now some investors might be saying, I have more desire for fixed income or bonds because there's no tax preferential treatment to buying that dividend instead, and I get a guarantee of my principal. So one hypothesis I have is this good for bonds? Could be. We don't see that as a negative.
Yeah, that could be.
They're not going to pay higher taxes. We're not investing in bonds for capital gains. So if anything, I could see higher demand for fixed income, another major unintended consequence of that tax policy.
And there's a definite demographic with substantial assets that are seeking low taxes in their retirement years right now.
Yeah.
Right? There's a lot of capital there. They're inevitably seeking sort of less risk investments at better returns net of tax.
Right.
Right?
And so then you're thinking, okay, well, what about cryptocurrency? I would theorize there's a lot of deferred long-term capital gains in cryptocurrency that individuals have pretended like they're never going to pay.
Except the people that are moving to El Salvador.
Yeah.
Right?
Yes.
If anybody's read that, there's news that there's going to be a tax haven in El Salvador for crypto.
So, I mean, it's just kind of as I think about these things and how they might impact cryptocurrency, the volatility there is just so high. You just wonder, what are they trading on, the types of events. But yeah, I can't see this as a net positive. It's absolutely a headwind for.
No, I would say the volatility within crypto is very much creates a lot of short-term activity, which is at high rates, as we've just discussed.
Right.
And so I would say if it pushes more people out of long-term into short-term by effectively making the rates the same, short-term and long-term tax rates, it pushes more people into trading on volatility than trading for a long-term hold.
Do you think that's positive?
For a nascent asset class that is trying to bring in new investors, especially those who have larger amounts of capital and like less volatility, I would say that's not great.
Right.
Yeah, I would say that's not great.
Right. Okay. So, any comment on tax policy on commodities? I mean, kind of similar things that we're just
probably not.
Yeah.
Yeah. At least in my wheelhouse, no. But if you're a huge commodity trader, it's probably worrisome.
Right. Well, and again, more of short-term phenomenon anyway. When you're looking at trading commodities, I mean, I think that there's a lot more of themes, especially if you think of a transitory theme of inflation. You would probably have a short-term view on commodities.
I mean, the overwhelming
oil's up 44% this year.
It is
$70 a barrel.
I think the overwhelming thought I have when I think about changes in tax policy is the game whack-a-mole, and that as policy comes in and whacks down and does something to make a change, something else pops up, and that's that unintended consequence where people figure out through planning geniuses like yourself on how to structure their financial plan to lower their taxes and have better outcomes.
Yeah.
So that's what I think of,
Yeah.
generally speaking.
Good. All right. So the final phenomenon that we want to talk about. So inflation, taxes, market crashes is something that I always say as the three biggest forces, the things that we need to plan for in any financial plan. So here we have inflation, taxes, and interest rates, and might be the same thing.
Okay. Yeah, I could see that.
Yeah. I mean, this is, look, if I look across the board of, here we are, we're at low interest rates. I mean, they've, gone up and down, and we've seen what just modest increases. I mean, modest is even too big of a word. Mm-hmm. Marginal increases in interest rates earlier this year, and the significant impact it had on, specifically the technology sector and growth stocks. Mm-hmm. But the things that have worked out well and seen the significant pullback in equity markets and fixed income markets, right, which is just a phenomenon of rising interest rates is because bond prices are falling. So if I look at higher interest rates and I look at stocks, bonds, commodities, real estate, cryptocurrency, I'm looking at red across the board.
And if I was just looking at Finance 101, the higher the denominator gets,
yeah,
the lower the output.
Yeah.
And I find myself personally justifying certain asset classes over another, even though the math is all the same.
Yeah.
And that's where I really catch myself, and I try to move from an interest rate to the second derivative to change in interest rates. And I'll bring that back because in the markets, in capital markets, whether it's fixed income or in equities, rate of change is so much more important than any sort of absolute level.
Sure.
So if we're moving, if we are moving higher in interest rates and we do it at a slow and measured pace, mm-hmm. there's lots of adjustments that can be made that keeps capital markets intact.
Yeah.
People have lots of ability to change, to adjust, whether that's through pricing, as we already talked about, whether that's through even just reallocating their individual portfolio to certain issues that will work in that environment. I think rate of change, if it is a sustainable rate of change, I think you could have a Goldilocks scenario. Mm. If the rate of change is substantial, then I think you'll see a substantial reaction.
And the reaction, I would hypothesize, is likely to be substantial, and it's just about how long it will endure, right? When will that rebalancing or that releveling, to higher interest rates happen? Because that rate of change, right, the stock market being this leading indicator of, okay, so we're going to have to take that rate of change and then work that out over the next 10 years, right? It's kind of how the Fed's talking about transitory inflation versus no, this is the rate of change that we're going to have happen over the next decade. Mm-hmm. Right, and so when you look at the stock market and how it reacts to rising interest rates, that rate of change gets exponential, mm-hmm. right, as they kind of run that out. And so I think what investors should prepare for is volatility, whatever that number is. When mm-hmm. interest rates inevitably go higher, that it's not good for stocks. And what you're talking about is basically a discount rate or a hurdle rate, right, of what you can earn on cash mm-hmm. or fixed income. And if that's zero, you're going to be willing to pay a lot more for a stock as far as the multiple of its earnings, versus if you have the ability to earn a couple percent over here, you're willing to pay a lot less. And that small move has a really dramatic impact, right, on those equity prices. Those are things that we saw earlier this year. Especially,
you mentioned it, growth equities. And there's been a term used in reference to equities that we haven't really used very often, which is, at least in my experience, where we've talked about duration growth equities, mm-hmm. effectively equities where their cash flows are way into the future, growing at rates 20, 30, 40%. You start discounting back those huge numbers, discount rate really matters. On the other hand, value stocks, which are effectively discounting cash flows 1, 2, 3 years out, mm-hmm. The discount rate matters less. It does. It matters less than that. It's kind of hard to talk about it here on the show because when I think about duration, I immediately go to fixed income.
Right.
And so now we're using duration in both
it's discounted
areas,
cash
right?
flows.
It
right?
is.
It's just discounting cash flows in the future.
Which just gets back to, it is math.
Yep.
And when the denominator goes
It's just
up,
math.
when the denominator goes up, it gets a little more challenging.
Yeah.
Now, think about why your house might not go down if rates go up. It might not go down because the cash flows from a comparable rental are going up. And if the cash flows are going up and the denominator is going up at the same time, that means the numerator is going up and denominator, which brings you back kind of where you started.
Well, that's kind of the Goldilocks scenario that I think you're referring to, right, as in the stock market. But there's going to be some capitulation as we adjust.
Certainly.
And so, real estate, we talked and hypothesized, I believe it was in the last show, right, where we're likely to see as mortgage rates go up to be a flattening, right, of real estate and to see how much that rate of change endures, right? So that's kind of the first move. The real estate market doesn't price like the stock market.
No, one tick a month.
Yeah, the impact and volatility that you see in the stock market is just, times 1,000 of something that you'd look on in a chart in real estate. So, yeah, we think there's going to be a lot more there. And then, so real estate flat to, it's definitely not positive, okay? If it costs more to buy a house and you need $1 million mortgage and you can get a mortgage today at 2.5, okay, here's how many people can afford that. Well, if that is all of a sudden 4, there's a lot less people who can go get that house.
That's right.
And so the demand goes down pretty significantly, pretty quickly.
Right.
Especially the size of these mortgages, the size of the real estate it is. Here we are in Southern California, so I talk about $1 million mortgage as being just kind of the baseline, right? But, the math works, and wherever you are in the country, it's the same kind of percentage of a whole budget of a household. So those interest rates going up, the demand for those houses are going to go down. Those prices are going to have to come down. Mm-hmm. So, okay, great. Not good for stocks, not good for real estate. What about bonds? Well, bonds, the higher interest rates literally mean falling bond prices, right? I mean, that's just what higher interest rates literally mean, is that they have an inverse relationship, right? So bond prices go down, it means that interest rates higher and vice versa. So that's obviously, we know that if rates are going up, fixed income is going down. Now you can reinvest in fixed income at higher rates, which is good for reinvesting of your portfolio, right? But the first move is down. Commodities, if we have higher interest rates, same kind of phenomenon, right? Still a higher.
It depends. Are rates moving up for inflationary reasons, or are they moving up for?
Yeah,
right. It does depend.
I'm kind of circling here to get back to that, right? Is how do we get to higher interest rates? So just getting through this though. So, and then cryptocurrency, I think we kind of looked at that in the same realm of the growth stocks. When we look at a portfolio, edging out from cash to fixed income to your large cap core value to your growth to your small cap to your emerging markets to your you go out to cryptocurrency way there on the risk spectrum.
That's right.
And those things, as I go out in the risk spectrum, as interest rates go up and that discount factor gets higher, they have a dramatic
they do
reaction.
So if I was just going to put an umbrella over this whole thing here, just really quickly and really kind of speak to our audience that's been listening for the last 13 episodes, where we've talked a lot about Fed chairs and Treasury secretaries and all these things, I would say over the next 6 months, instead of just listening to the words that are coming out of our Fed chair's mouth, think about what sort of expectations he is trying to set. Because if you go into deep in the weeds in economics, especially in monetary policy, so much about what they're doing is trying to set expectations. If I don't think prices are going to go up higher, I have no incentive to go out and increase demand. But if I think prices are getting higher, I'm buying it today. And the more that expectations grow, the more demand grows. The more demands grow, the more prices grow, and it keeps moving on and on and on. And so pay attention and kind of sit back and try to use a different lens and think about what they're trying to say that may be actually 1 or 2 layers deep. And so much about what we're trying to do to exit all of this scenarios is all about setting expectations. And so far, they've done a really good job, because we just hit a CPI of, what we say, plus 5%, and the market is making a new high.
Right.
So let's not lose that perspective, that the S&P closed at a new high, hit new highs yesterday, new highs today, while we sit here and talk about all of these challenging times, a market, equity market specifically, love to climb a wall of worry.
Yes. So also the 10-year is below 1.5 at 1.4.
It's true.
Okay.
Yeah.
So this is where we're getting to that all of these good times, right, that could continue for some time period, right, will be okay. We might have some runway. The Fed seems committed to that. There is absolutely a point in the future where they will not control interest rates. It is going to be dictated, and usually is dictated by some market phenomena. And so you have to look at Europe. You have to look at where their equivalent of a 10-year treasury, their sovereign debt, and what they're going to be priced at, right? And how that's going to be relative to ours. You have to look at China's demand for treasuries. And so there's a lot of things going on globally that the Fed might not have a say in what happens to interest rates. And so even if they can continue to stay dovish with policy, you kind of wonder, are you just kind of building up the magnitude of this event and how significant it might be in the future? And look, I am well aware that you can see your portfolio, all these asset classes, real estate, stocks, commodities, bonds, if interest rates stay low, you can see 40% increases in prices, just a random number I'm throwing out, right? It could be anything. See some positive, significantly positive, growth in your overall portfolio across asset classes before you have that traumatic event. So I don't want to hypothesize that this is around the corner and something that everyone's got to, stay on the sidelines. In fact, that's probably going to punish you pretty bad doing that. But something of why you want to make sure you have a diversified portfolio, why you want to have a strategy, why you want to talk to your advisors about inflation, taxes, and market crashes, because these phenomena will happen. And we will see some very, very challenging times across asset classes. I think of 2020 with the pandemic, we got a lot of life lessons. We had some investment lessons as investors. I hope a lot of people paid attention that there is periods of time where things don't go according to plan. And we got out of that pretty quickly from a market's perspective. You and I have lived through more challenging markets, and we know that we will live through them again. And so as we look at inflation and taxes and interest rates, we know that these things can have dramatic impacts on all sectors of these portfolios, some good, some bad. But having the plan, don't pretend like they don't exist, right? And then know, what are you going to do during those times, right? Because if you don't have a plan, you didn't talk about it, and those events happen, now you're reactionary. Typically, we're making poor decisions in that environment. So that's my little takeaway for the show.
I like it.
You like it?
Buy high, sell low.
No, let's not. Let's not end on
That's the message.
Yeah.
When you don't have a plan.
When you don't have a plan.
And you're acting on your gut instinct.
That's right.
Typically, you make a poor decision.
Which is how you lose money, right?
You run out of the burning building.
And we talked about time horizon, and that comes through financial planning and what empowers investment managers like yourself to really make good long-term decisions for a client's portfolios rooted in that financial plan, which allows you as an investor to really remain calm, cool hand Luke during those bad times, knowing you got 10, 15 years for this thing to work out. You're not panicking. You're probably buying.
I think for episode 1, I'm just gonna be cool hand.
Cool hand. Episode 1 of season 3.
That's good. On to season 3 on that. I
gotta eat 50 eggs on that show, though. All right. A little shout out to Paul Newman there and our new cool hand Luke.
That's right.
Luke Jacobson, portfolio manager, Presidio Capital Management. Dustin Tembrook, it has been a pleasure being with you. I also have to give props to Sierra back here, putting this show together. Wow, awesome.
Let's get it.
We got to get you out in front of the camera one of these days. But Sierra's on the ones and twos, making this all happen. So much appreciation to you, girl. You're doing awesome. Studio's looking good, too. It's good. I like it. All right, guys. Enjoy your summer. We'll be in touch. Luke and I are going to be hard at work, even though off of the camera here for a little while. But give us a call anytime you want to talk about your portfolio, your plan. We're always here. Follow us on YouTube and Facebook, and find us at presidiocm.com. So, Luke,
all right, peace out.
Bye, guys.